Good morning.
Good morning.
You automatically come in muted if actually, Bob, I didn't hear you, but you're not muted.
No, I can hear you and I can see you very clearly.
Maybe it's my speaker. Let me
Can you
check
hear
that.
me now, Ernie?
Test speaker. Testing one. Oh, I have it on the wrong thing. Okay, I should be able to hear people now.
Can you hear me, Ernie? It's Bob.
Yes, I can, Bob.
Okay, very good. Did you want me to mute?
It's completely up to you. You can chime in anytime you want, but generally I like people to mute unless there's, and I'm not really giving a presentation per se. This is sort of just a live session going through the first day and bringing everybody through what I'd be looking for to set up a trade.
Thank you.
So I expect more people to show up soon. Where are you, Bob?
I live in Raleigh, North Carolina, but I'm from Australia originally.
Ah, you like North Carolina?
I do. You know, I lived in New York for a couple of years and it beat me up, and I've been in North Carolina for about 25 years.
Ah, I live in the Boston area, and we've been thinking of an area that has a more temperate climate.
It's really good here. You know, life is difficult at the best, and this makes it just a little bit easier.
All right. Although the weather here hasn't been too bad. You'll have to excuse me. Let's see. I will admit. I may be guarded with my voice only because I just got over COVID. I had a pretty bad bout of it. But
You look well.
thank you. It was a really nasty disease. I never get sick. As a matter of fact, the last time I had the flu was over 50 years ago. And last time I had a cold was probably 20 years ago. But the COVID got me, but it didn't really. My wife had a fever for 2 days, and then she was done with it. And my two adult children didn't affect them at all. And they all tested positive. But it really did affect me. I was fortunate to learn about ivermectin, and I self-medicated with that, and that basically cleared it up in under 24 hours.
Dad, I read a little bit about what you said regarding that. Amazing. Thanks for sharing that. I didn't know about that. My dad recently got it as well, and he's recovering. But thank you for the tip.
You're welcome. It's not approved. It's not approved yet. I don't know why.
Yeah. The only other thing, Chris, if you can hear me, my daughter got COVID-19. She's obviously younger, but she used Mucinex, 12-hour Mucinex, which you can get over the counter, and it really worked well.
Wow.
For younger people, it's a whole different story, I believe. When you start getting up above 60, I'm 60 years old. I think it's a very different story. It's touch and go. You'll either get it hard or not. It seems that women get it at a less, little less.
My father is 74, and he got it in early November, and is still recovering. He went to the hospital in Charleston, South Carolina.
I have a friend that's 2 years older than me, and he's just being sent home from the hospital. They're sending him home with oxygen.
Wow.
And he's still in bad shape.
But during the process, my father lost 50 pounds.
Yeah, I couldn't eat. I couldn't eat at all. I couldn't sleep either because I was constantly trying to catch my breath and not go into a coughing fit.
They do say if you lie on your stomach, that is really meant to help.
Huh. Well, I tried every position.
Yeah, sure.
So zero DTE, I'm trading it with the E-mini futures. And wow, this will clear up a bit. I just need some water. And there are a lot of advantages of using futures. One is that you have basically continuous pricing throughout the day and throughout the evening. Futures contracts are open 23 hours a day. So that's very different than, say, using the SPY or the SPX options, which are only open during the cash market from 9:30 to 4.
Ernie, could I ask you a question?
Sure.
My broker Fidelity doesn't offer futures products. Are you suggesting that I shouldn't do the zero DTE?
No. You can definitely do the SPY, and you can, because generally the activity or the trading that we'll be doing will only be between the cash markets.
Okay.
But it gives you the opportunity, at least with futures, to analyze prior to that. Are you sure that Fidelity doesn't offer futures?
100% sure.
I would open up an account with like Tastyworks or Thinkorswim. I have a Fidelity account, but I haven't funded it for a while, so I'm surprised that it doesn't offer futures. So today, or this morning, we hit an all-time high in the futures market. And that may be different from, say, the SPY or the SPX. I'm going to take a look at what the SPY and the SPX look like as well. So no, yeah, it looks like, need to change this here. Go to a 5-minute chart. Yeah, so in the overnight session in the SPY, it also hit a high. But at the open, it looks like it's dropping on the open. So the main goal here with zero DTE is that you want to get at least one leg, possibly two legs of a trade in. One of those legs will be a put spread, the other will be a call spread. And together, if you get both of them in, then that would make essentially an iron condor. You want to have these legs far enough away so that you can collect enough premium, but there's a good probability of staying out of the money, so that the leg doesn't get compromised and bring you to a loss. So for that reason, what I do is, for a put spread, obviously that's a bullish trade. I'm waiting for a dip in the price as early in the market as I can, and then enter that. And then hopefully I find something near the bottom. If I'm, say, at 16 deltas, that's usually about an 84% probability of being out of the money by the end of the day. And that usually translates to about Well, it depends on what asset that you're using, but it could be anywhere from 5 to 10 strikes away from the money. So it would have to move a fair amount in order to whatever price that you chose to compromise that. Obviously, the better that you choose as the market is opening, or as the market is progressing, what you feel is a bottom to today's market. If you can get the exact bottom, that would obviously be beautiful. The next step. Yeah, go
I
ahead.
was just wondering how long do you wait before you would enter the trade?
Well, that's I guess the secret sauce or the magic bullet, or the person who gets the bottom wins. I don't know. Nobody knows. So you have to use a fair amount of analysis, and there are a number of things that you can do. But you also have to have situational awareness about what's going on in the current market. So, for instance, today, I know that at 9:45 and a little bit after, there are a couple of significant economic reports coming out, which is unusual for a Monday. But you should be cognizant of those because they could move the market. Let me see if I can share my screen. So we can see that, this is just different versions of the trade. The top left is the SPY, and all the other panels are showing the E-mini S&P. And the gray area on the top left one is showing the outside the normal market hours, and the dark area are the market hours. Of course, with the ES, everything is the market hour. Bottom left is 4 hours, top right is 1 hour, bottom right is 5 minutes. I have to admit to other people. So welcome, everybody. This is I'm just going to say that this is a tutorial on how I set up a 0 DTE trade. I'm not promising that I'm going to make a trade today. And it's not necessary that you make a trade in a day, although, that's the objective, of course. But in general, we're trying to ultimately put on an iron condor. That would be the best case scenario, where we have a call leg, a call spread, and a put spread bracketing the current price. And we're hoping that by the end of the day that we stay between those two, and that we can close the trade at the end of the day by not doing anything, just letting it expire, thereby collecting the maximum premium. The hard part is, actually getting into the trade. Now, it's not necessary that you get both legs of the trade in. So, for example, let's say that we have a runaway market and it just goes straight up. At some point, you're going to look for a dip so that you can get in and decide that, hey, look, I want to get in here with a put spread. And generally, I would put that about 16 deltas out of the money, which is about an 84% probability about staying out of the money by the end of the day. Now, if the price just keeps on going up, I'm not going to just arbitrarily put in a call spread with the idea that if it goes up right through to the end of the day, if that's the type of market it is, why put the call spread on? That would just lose money. However, if it started to go up and then, made a nice little turnaround and you determined that that looks like it might be establishing a high for the day, then that might be a place where you enter a call spread. Does this make sense to everybody? So, feel free to, unmute yourself or do whatever, or type in the chat. Just make sure everybody can see you're typing in the chat. So anyways, I'm going to go back to my screen. Thanks, Louis. Louis and Eddie, Eddie's asking, would you use a 5-minute volume profile? You're going to use whatever tools that you think are going to give you the the most information for you to place that first trade, and then subsequently the second trade if you can. So I like to use multiple time frames and multiple tools. Right now, I'm just looking at the Thinkorswim charts. I gotta let somebody else in here. So right now, I'm just looking at the Thinkorswim charts in multiple time frames, and trying to get a feel for what's happening in the market. So let me go to that. Let's see. Before I do that, I'm going to see if I can detach this participant so I don't have to jump back and forth, and then I can just admit people as they come in. And I'll detach the chat as well. All right, now I'm going to share my screen. All right. So here we can see that the market has dropped pretty strong right at the open. The market's dropped pretty strong right at the open. It seems to have, at least on the 5-minute chart in the lower right, it seems to have found a temporary bottom. Now, I don't know if that's the bottom or that's just resting a little bit to find a way a little lower. Of course, nobody knows, but we got to make our best guess. The earlier that you can put a trade on, the more premium, and particularly in the first 15 to 30 minutes of the market, the more premium that you're going to find available to you in your whatever asset that you're trading. In this particular case, I'm trading, again, the E-mini S&P 500 futures product. The current month is March. Current expiration month is March, so it's ESH21. Now you can trade the SPY, or you can trade the SPX, or you can trade the XSP, which is a mini version of the SPX. All of them will give you the same number of strikes and option chain delineation. I prefer the ES for a number of reasons that I've explained in the Discord. Anybody have any questions so far? So I kind of like the idea of having this meeting format where we can all get in and share ideas, ask questions. And if you would like to do something like this, I can arrange that so that we can maybe make that part of the service where on Monday, Wednesday, and Friday mornings, we start off and see if we can make that initial trade. Would that be of interest to people?
Yeah, 100%.
Good. So, like I said, it still looks, let's say that we decide that it looks like it's making a bottom here. And, well, what would be the most logical first trade to make? It would be a put credit spread because that would be a bullish spread. So we would want to put it underneath the market. So the way I'm just going to go through the mechanics of what I would do. Just saying timing before 10 Monday, please. Yeah, I would start at the cash open to the market at 9:30. Maybe even start 15 minutes before 9:30. My voice sounds guarded. That's because it is. I feel like I could break out into a coughing fit at any time. Although I want to tell you that this is about 1,000% better than I was 2 days ago, which is 1,000% better than I was 2 days before that. So I'm hoping that I can make it through the whole thing. So, looking at the chart, it looks like it was just taking a rest and it may be going down further. So you don't want to be, too aggressive here. In this particular case, maybe we start off the call credit spread, which is a bearish move. Now, how would I choose that? Well, the way I would do that, I'm going to start by going to my Analyze tab. And I already have here, I can show you. These are all the contracts for the ES over the coming days and weeks. The very first one, the January 21, 0, that means 0 days to expiration, is the one that we want, which is the Monday contract or week 2. So you can see Monday, Wednesday, and then the one that doesn't say anything is Friday. Sorry, I can't get to the cough button quickly. So I'm going to expand the 0 days of today's expiration. And then scroll to at the money. All right, here we are. I'll go back to the chart. We can see we're continuing to move down. Obviously, if I'd had put in a call credit spread at the very beginning, that would have been a damn good move. But we didn't know. It just started to drop. But let's say that I feel like maybe here's a good place to put a call spread that I feel that it's going to continue to move down, which it looks like it might. Maybe what I want to do is check that from a volume profile perspective. So I think this is delayed by 15 minutes. 37:43. Let me just check to see what the live time is. Yeah, 37:38. So yeah, the my trading view is delayed. So, but in any case, it looks like there's a big volume node here, and that we're heading down towards that. We have a small child node here that was created by some activity that happened on the 29th. Question is that going to be where we hang out and find support and then move up, or just continue moving down into this bigger volume node, which was established last week? All right. So I think that, if we put a trade in above the market here, that's probably going to be a good place to start. So I'm going to go back to Thinkorswim. And, that's around the 3770 area. Let's take a look at what that looks like from an analytical point of view. 3770, that's way up here. I mean, that would be like a 6 delta. Now, on my Thinkorswim, I have it set up so that my columns are showing my bid, my ask, implied volume, volatility, the probability of being out of the money, and then the delta. Generally, I'm looking for between a 16 and 20 delta. And that usually that translates to about an 84% probability of it being out of the money. So in this particular case, a 16 delta right now is 3715. Actually, I'm sorry, that's on the put side. We want on the call side. The 16 delta over here is like 3760.
Hey, Ernie, can I ask a question here?
Yeah, sure.
How do you know what 16 and 20 delta by looking at this here? How do you identify that?
Okay, it's right on my
Oh, I see. I'm
my
sorry.
option chain.
Yeah, I see what you're saying here. Okay.
So I can change the the columns on my option chain to show whatever I want. Right now I have it changed so it's showing implied volatility, probability of being out of the money, and delta. I could also choose like volume and open interest, which a lot of people like to have, or delta, gamma, theta, vega, whatever I want. But in this case, it's, for our purposes, knowing the probability of being out of the money and the delta is really what we want. You can make the assumption that you're going to have plenty of liquidity. So why bother looking at, volume and open interest?
Right.
All right.
Cool.
So and then because we've moved down, we want to put something above the market. I don't know if we'll get a chance to put something below the market. But if we were going to put something above the market, that 16 delta comes in right about here at 3760 currently. So that's saying that there's about an 85%, 84% chance that we would come back up and compromise that 3760 mark. So we're far enough away now from that price that that's probably a good place to establish the one leg of the iron condor. So that's probably what I'm going to do. I'm going to go to 3760 here and right click on it. I'm going to sell a vertical. Now I'm in the analytical mode here. So that should show up at the bottom here. Here it is. Showing a 80 cent credit. Now, in E-mini futures, the S&P E-mini futures, that's not actual dollars like it would be in the SPY. Like in the SPY, an 80 cent credit would equate to an $80 credit, right? But because E-mini futures are $50 per point, it would be half of that. So you would be looking at, a 40, what's saying a 40-cent credit is actually equates to, I'm sorry, what saying an 80-cent credit actually equates to a $40 credit, right? So if I were to put that on, I'll right click on it and do a confirm and send. It would show that my max profit, because I have 10 contracts, I'm not going to do 10 contracts. And my max profit is, $375, max loss, $2,100. Buying power effect, $2,600. Now, there's no way I'm going to do that with the size of the account that I have. I'd probably start off with 2 contracts, so I'm going to bring that down to 2. And then look at what that looks like. All right, so $70 max profit, $430 max loss. That ratio isn't really exciting to me. The ratio of profit to loss. It would take up $525 of buying power. Typically, I'd rather have a ratio that's more like 1/5 or better. That's certainly not that. I'm just going to do a little quick calc. So 70 divided by 430 is only 16%. I'd rather have 20%. This is kind of telling me that the premium is kind of cheap. Typically, a 20% or better would be what I'd be looking for. So premium is kind of thin this morning, even though it's dropped as much as it has. So I have to look at something like that and make a qualitative judgment, is that a good risk for my money? Does this make sense to people?
Yes.
And, it's basically okay, so Lewis is asking, well, why would this be thin? It could just be a low volatility, low volume market. There simply isn't enough activity or demand to push the premium up. But, that's really on the edge for me. I'm not saying it's out of the question. It's just on the edge. But generally, I want to put trades on that have good value. So, we can, step back from it and take a look at the charts again. Sorry. I can't emphasize how sick I was and how much better I am now, even though I may not sound that way. So let Chris in. What I'd really like to see is price come up a little bit before I take the trade, because then I might be able to get a little bit more premium in that contract. The other thing I can look at is instead of just a single strike wide I might want to look at, and instead of say 2 contracts, I might want to go to 1 contract and look at a 2 strike wide contract. So what I would do is change the long leg another strike up. Right now it's at 3760/3765. Maybe bring the 3765 to 3770. This will give me more credit because it's wider, right? It'll be a more expensive trade, but the fact of the act of widening the spread actually increases your probability of profit because of the, it changes well, I'll show you. We go to the risk profile. Here's what this trade looks like. Let me sort of spread it out a little bit. There you go. Spread it out a little bit more. Computer's a little choppy this morning. All right. Is this where price is right now? 37.38. So anyways, too wide is giving me 95 cents, 90 cents, which still isn't great. And I don't know if it's within that 16 anymore, that 16 delta anymore. Might have to go back to that and take a look. I'm scrolling up to at the money. So a 16 delta now is at actually 37.10. It's actually 17 delta, close enough. All right, so that's a 55.60 credit. So you can see it's the credit right now is just so, the premium is super slow, super low. I'm not comfortable with that at all. Yeah, it's even worse. So that's $50 profit, potential profit, divided by 450 max loss. That's only 11%. So quite frankly, today looks like a shit day to do this, at least on that side of the edge. Let's see what it might look like on the put side. So assuming that we're coming near a bottom, which I don't know how you make that assumption right now. I mean, we could go back to our volume profile and see that, look, it looks like it's heading towards the volume profile, this node. And if it did, that would provide a fair amount of support in there. Maybe. But I would say I would give a good chance to do that. The middle, the POC of that node is at about 37.30. So it's going back to think a swim. Let's see what a a 16 delta trade would be. It'd be right around 37.07. So that's significantly even under that. Let's check out what a trade would look like. That'd be 55 cents of credit, which is crap. Wow. So a 17 delta trade right now would be at 37.05. Let's look at what that would look like over here. 37.05 would be way down here. So that's saying that from a statistical point of view, price would have to go all the way down here to be a 83% probability about it in the money. I mean, that looks a little bit more palatable to me. It looks like you could get away with something less than a 16, maybe go to 37.20, which is at the bottom of this node sticking out here, which seems like it would have good support there. Are you following what I'm doing here? The
Yes.
green line represents the, what would be our standard, which would be 16 delta. But as I've said in my documentation, I like anything from 16 to, 25 delta. Let's see where a 25 delta would bring us. So I'll go back to Thinkorswim. So a 23 delta, which would be right around 37.15. Let's change this to 37.15. Now it's 3 strikes wide. Now a 3 strike wide 37.15 is a $1.85 credit. You may not want to, your account may not be able to handle that, but for one contract, a 3 strike wide at 37.15, which gives us a 25 delta. So that's $95 profit, potential profit, max profit. That's 95 divided by 655. So we're still only at about 15%. Still shit. Maybe I'll close this up a little bit and just maybe try a so two wide is giving me something a little bit different. 2 strikes wide. Let's see what 2 strikes wide is giving me. $77 on $422 max loss. So that's 18%. We're getting there. So a 2 strike wide put spread will make me about 77 bucks. See what that looks like. So this is what it looks like. And then from a chart point of view, it still looks like it's going down though. Still looks like it's going down. One choice that we could make here, if you're willing to take the risk, is that we could put that original call spread at 37.60 on, um, really, get slim pickings for our money. But there's probably, at this point, it looks like there's little chance that the market's going to recover and go through that. I mean, that might be a choice you want to make. It's not the kind of choice I like to make. I'd rather go in although I don't know how you feel about it. Let's see. And he's asking, do you look at the volume at a strike that is traded on the 0DT and not? No, I don't care about volume or open interest when I'm dealing with the E-mini S&P or the SPX or the SPY. I would never do that because, first of all, there is no more heavily liquid thing to trade on the market, period. So why bother? Volume means really nothing. It may be relative to the day before, which is probably true. But, I wouldn't look at it and to say, oh, this doesn't have enough volume. Obviously, it doesn't have enough volume because we're not getting enough premium. So really, volume and open interest with the SPY or the ES or the SPX is it's a useless metric to look at. We always assume we have plenty of volume and liquidity, considering that it is the most liquid thing on the market. I guess the only thing that might be thicker or more liquid would be, like 20 or 30-year bonds. The NQ or the NASDAQ futures might be close in terms of liquidity. And in fact, it does also offer Monday, Wednesday, and Friday expirations. So it's another possibility. But it looks like we're just going to keep on going down. This is like this is the most difficult market to trade when it goes in one direction. Because by the time you realize it's going to keep going down, where do you put your trade? In this case, what I would do is I would go back to my volume profile and look at that. I still think it's probably going to ultimately end up inside of this big volume node. I guess if you look at this minor node up here, but there's so little activity behind it because we're at all-time highs. Price could turn around and easily go right through it. You see the quandary that I'm in here. If I had history behind me in the form of more volume profile, where I could see where there would be natural places for resistance, I would probably, not be reticent to put a trade, put a call credit spread up here. I may do that anyways. Let's see. So right on the edge of this volume node, it's at about 37.53. You could take a look at what that looks like. So call credit spread at 37.50. 37.55 is a 14 delta. At 37.50 is a 21 delta. it really doesn't look like price is going to go back up there. Let's see what that would give me. Sell a vertical spread. Again, 90, 85-cent credit. I mean, look, am I desperate for, $45 with 500, with $445 of risk? That's a qualitative judgment that you have to make. Bob's asking, you did the, you said that you did the put spread down below for 70 cents. 37.20, 37.15. I can't argue with that. Just in my experience, this is a very small amount of premium that I wouldn't normally go after. Because it looks like it's just going to keep on going down. Is the premium lower? Does that mean the risk is lower? No, actually, it's the other way around. Because the width of the spread is always the same. So the smaller the premium, the more ultimate risk that you're potentially taking. Also, you'll find that when you have small premium, the steepness of the curve of that zero DTE premium line is more acute. When you have more premium, it's less acute. It's like closer to parallel than vertical, which means that as price moves, the delta changes, the amount of premium changes less. I mean, ultimately, what you want is something that's as close to delta neutral as you can when you have the bracketed trades on. So let me just do an example. Let's say that I put a put spread in here. We'll see what it looks like. So let's do a 20 delta, a 37.10 put spread. And then on the call side, I'll do an 18 delta. I'm going to bring it down to one contract each. And I might just put this trade on just for shits and giggles. Oop. What, did I miss something here? All right. All right. So here's a trade that I've chosen. It is a 37.50 call spread, 37.50, 37.55 call spread, 70 cents credit. And then the bullish part is the put spread at 37.10, 37.05. All right. Right now, price is pretty much centered right in on that. I'm going to widen this a little bit. I mean, this might not be a bad trade to start off with. Now you can see the purple line is skewed towards the downside. It's fatter on the left-hand side than it is on the right-hand side. But, you know, and it's pretty early in the day. It's 10:30. You know, do we think that price is kind of stabilized around here? We've come down. We've had a little rest here, little pullback, come down again. It looks like we have diminishing moves down with another green candle on the 5-minute chart. Well, it's not green now. At 37.29. Maybe looking at that on the volume profile. $37.29 is right there, right on, almost right on the POC of this node. So it looks like the trade that I've put on let me see if I can illustrate it. $37.10 at the top, and at the top, what was it? The call spread was 37.50. So that's all right. So there's the profitability zone. Just to illustrate it some more, I'll let's show where it stops being profitable. So if I were to put this iron condor on now, this is kind of like what it would look like. Let's see, where's the end of the day? That would be the end of the day. So visually, this is kind of like what this trade would look like. Now this is a 15-minute delay, and I think price is right about where this green line is right now. $37.27. Let's just check that. Price is right here, $37.28. All right. So there's the bet. Wouldn't be really risking a lot. And I think that take a look at the charts. I don't know. it still looks like it wants to go down further to me, just this pattern. I don't see any like significant consolidation yet. I'm looking at the lower right-hand chart. Actually looking at any of them, don't look like it wants to stop right there. Obviously, if it ended up there at the end of the day, that would be ideal for this trade. Lewis is asking, how do I adjust my risk return on these types of trades? So we, on a monthly basis, expect 20% return. If we put on delta at 20%, would we turn this down to say 10% return by putting on delta at 10% trades? Just using numbers. Yeah, that makes pretty much sense. But you know, the way you adjust your risk really is how wide and how many contracts you use, how wide you make your spreads. How wide you make the iron condor. So yeah, if you go to say a 10 delta, you're using a lot of money, you know, to try to get a small amount of profit. Your risk is probably lower, but if it does move down to one end, it's going to be much more difficult to try to adjust. Yes, profit reversing buying power. It's, you know, it's how much money you want to use to try to make so much money, right? So, you know, you could go out in the world with say $1,000 and say, look, I'm going to put $1,000 to work and I expect $500 back. Seems like a pretty good return. But then on another day, you go out with that $1,000 and you realize you can only make $15, putting all that money to work. You know, which do you think is the better deal? So I would say that if we have a few more candles that show some support here, I think I'd be willing to put on this trade. Although the trade itself is, you know, small money. I can increase its value a little bit by widening the spread on either leg. Let's try that. So there I widened. I haven't really increased my risk a lot, but I've added more than double the credit. So now my max profit is 122 to 375. That's pretty good. 122 divided by 375. So now I'm up around 30%. return on capital. So by adding both sides of the legs and increasing the width of each leg to 2 strikes, I'm able to get something I think that's palatable. That is, if I think that, you know, price is going to stay centered here. Yeah, we just had a nasty move down. Now, if this recovers some, oh, people are waiting. So we've made another, you know, hello? Too much of a delay. So I'm not confident yet that we're going to hang out on this volume node. And right now, we're exploring the bottom of the volume node right about here. I mean, if we can come back up to that POC here, I think this is a good trade. Maybe putting on the call spread right now is a good trade. And then adding the, if it should go down further, adding the put spread later. I think that's what I'm going to do. So I'm going to take the call spread. It's lesser credit. And I'm going to add that. And I just got filled. I would say that if we consolidate anywhere around here in the next 20 minutes, I'll put on the put spread too. You know, I guess the biggest thing here is, do I believe we're going to hold this line here? Sure doesn't look it. If we keep on going down, then the call spread becomes, you know, higher probability, which is fine by me. It's like free money. So Bob, your put spread might be getting challenged soon. Or it's coming close to it anyways. Now, there are a number of ways that you can adjust. I don't like the idea of rolling out. Kind of defeats the whole purpose of zero DTE. I can see rolling down and taking the loss on a challenged position. The other thing I can see is tightening up the opposite leg, bringing it even closer. That will offset loss a bit by taking in a lot more credit. The other thing you can do is simply add another put spread in this case. That's a little bit further out. Generally, adjustments should be more aggressive than defensive. When you start becoming defensive, you're better off just taking a loss. It's been my experience. If we can get price up to 37.25 or so, I think that would be a good spot to add the put spread. Or if we can just get it to hang out here for a little while longer, establish position. Get some consolidation here. Maybe some, on the 5-minute chart, a couple of higher highs and higher lows, because looking at the volume profile, see if I can go down to smaller minutes. A little more detail. So this is a 15-minute delay on the trading view, and I'm using a 15-minute chart. So I'm one bar behind. Looks like a fair amount of activity here, right at this level at 3722. When did the meeting start? It started at 9:30. You know, I think that this is probably a good spot to put the put spread on. Um, I'd like to see another 5-minute bar here before I do it. So I just added in a linear regression slope, which on Thinkorswim is the TTM squeeze. I think what I'd like to see is 2 yellow bars. The linear regression slope will show me direction and magnitude of direction. So right now, direction is still decidedly down. If this last bar turns yellow, then that means that it's changing direction. But doesn't look like this, this last bit of activity has proven that out yet. If we can get that to be a printed yellow bar, and then the next bar to also be printed yellow, I would have much more confidence to put on that put spread. That means from a linear regression distribution point of view of prices, that it's starting to turn, that the slope of the directionality is changing. But obviously we're not there yet. We had yellow there for a bit, but then this last push down seems to have kind of wiped it out. Might come back. That's one, volume profile and the linear regression are my 2 strongest tools. You can see on my trading view, I also have a linear regression. This is similar to the TTM squeeze on Thinkorswim. They call it the SQZ MOM on TradingView. But it uses the same calculation. See if I go to a 5-minute chart. Yeah. It's just not there. See if 30-minute. It's interesting, we have a negative divergence here. We have these 2 peaks on the linear regression slope. And then these 2 here. That's a very strong, we could have predicted right from the open on that we were going to have a downturn, perhaps not the extent that we have, Still looking to put in a, well, you're welcome, Bob. See ya. Still looking to put in a put spread. I just don't know where that's going to go. This green line, this green box is indicating where I had originally intended it, but it's getting a little too close to comfort right here. We can see on the 5-minute chart, it just hasn't yet decided to turn. We have the call spread on, so it's at least making some money. And it'll probably end up going all the way to the expiration. Again, I need at least 2 yellow bars to show that there's some turnaround here. When do you enter iron condors? Is it usually converted from a call spread or a put spread? The answer is yes. It depends on, what direction the market initially takes, whether I put on or start with a call spread or a put spread. In this case, I started from a call spread because price was moving away from us, and it looked like the call spread leg was fair value and low risk. The next step would have been to put on the put spread to complete the iron condor, but I'm waiting for a spot where I can put that put spread on. Right now, I don't see a viable place because the market keeps on moving down. All right, Lewis, take care. But I suppose there's an opportunity here to put on more call spreads if you felt like price wasn't going to recover all that much. But where do you put it where it's a good value? Sorry, my voice is so labored, but I am so much better than I was. Now, I'm just not so sure whether or not we're going to get the opportunity. We will eventually, I think, to put that put spread on. But it's like trying to catch a falling knife, Is this an ominous sign? An ominous sign for the first trading day of the year? Well, the good part about it is that the call spread has probably already made maximum profit or close to it. It's not a lot of money. Probably be about 25 bucks. Our Netflix trade is still in the money. Yeah, our Netflix trade looks pretty sweet. So the gray area is showing the one standard deviation move by the end of the day. Let's see here. What's today? 4th. Now I've only put on the right-hand side of this iron condor. The left-hand side is an analysis trade. You know, that was the original one I was looking to put on. But now it looks like, it would make more sense to put it out here somewhere. Oop. You can try some different things. Maybe move it down to 3,700. 3,700, 3,790. That doesn't look like enough. That would bring in $3 credit. Bring it down even further. Say 3,680. Like that. I'd give $1.55 credit. So there's an option. Put in a 36.80, 36.70 put spread, collect $1.35. That would that would give us a pretty good delta, very close to zero, only $1.94, and a theta of $70. So at 36.80, 36.70. Let's take a look at the chart, see if whether or not that makes sense. Not yet. But if we can maintain here for the next couple of bars, next 15 minutes or so, it might be a viable trade. I just don't know how low we're going to go. We're starting to come to the edge of this volume node. It's rather ominous. Could drop quite a bit more if it enters into this volume well. Hey, Chris. This is a rather unusual day where price just dropped off the ceiling, just straight down. We can come out of this day making any money, that's great. Looks like we will on the call side. I think eventually we'll get a put spread in and maybe add another $25, $30 to the take. All right, Chris. Everyone's dropping off. In the first day, we're going to make money. Even though it's not a lot, it's still making money. Wow, we're right at the edge of that volume node. Wow, we're dropping into that volume well. Looks like it's going to come down hard, maybe, or get rejected. Be nice if it gets rejected and pushed right back up into that big blue volume node. Man, that looks nasty. Looks like it still wants to go down. Wonder what happened to those economic reports, how they may have affected the market. There was one at 9:45, the PMI manufacturing final. Let's see what that says. Well, it was, that's interesting. It was higher than the consensus. I'll bring this over here. So the PMI manufacturing call today had a consensus of 56.5 with a range of 56.3 to 56.5. And it looks like it's well outside or above that range. So that's real solid results for Purchasing Managers Manufacturing Index. There was another construction spending at 10. And it looks a little bit below consensus. So construction is contracting a little bit. And year over year, the average has dropped. Month over month has dropped as well. That looked like it was a pretty impactful report. Looked like we had some Fed governors speaking at 10 o'clock too. And then again at 12:15. It's a possibility that we might be leveling out here. But we're so far deep into this volume well, it's kind of scary. Price would have to jump up pretty and return into this activity here. Unless we establish another new child node here, which is a possibility. But it doesn't look that way. Looks like we want to keep on going down. So Steve, David, and VVVVV, thank you for hanging on. I think I'll probably cut this short in a few minutes. I don't expect anything to change dramatically here. If it does, then I'll go into the Discord and I'll announce the the opening of that put credit spread. I mean, that's really the only other thing that I can see doing by the end of the day. Maybe end up doing it in the mid-afternoon, which wouldn't be so bad if we start establishing a base here. Might be a very good trade. So I'm going to take this off a share and say that that's what I expect to do. I don't know where the bottom's going to be. We could be going down much further. Hopefully we stop at some point. But one thing's for sure, that the call credit spread is now fully in profit. So I'm not going to do anything with that. I'm going to let it expire. And sometime near the end of the day, if it shows some kind of bottoming out, is probably a good opportunity to put the put spread and collect a little bit of money. All right, so I'm going to stop here, and I'll post this on the website, and we'll continue any other further trades in the Discord. Thanks.